In this video, we're going to talk about another one of the very critical theories in finance, and that has to do with stock prices, right? So the models that we've talked about in previous videos to find the value of stocks, it links together the cash flows of the company, the cost of capital, and share price. So again, if we have accurate information on any of these two variables, then of course we can solve algebraically for the third. So they have what they refer to as the valuation model Triad, which shows the relationship. Again, if you know two of these, or if you're fairly certain of two of these, the third, you have an understanding of what its value might be. Now, if you think about information, right? Is the information that we have, is it good information, right? Is it sound? Is it accurate information? So for publicly traded firms, the current stock price should already incorporate accurate information. And the reason we have for this is that there are a multitude of investors, thousands and thousands of people who are analyzing companies and gathering their data and pulling it all together. So the price that we see is the true value of its shares given the information that we know. So based on the current stock price, a valuation model will tell us something about future cash flows and or the cost of capital. So the theory that we're talking about here is something called the efficient markets hypothesis. It implies that securities will be fairly priced based on their future cash flows, given all the information that's available to investors. Now, there's really two kinds of information. There's public information and there's private information. So public information is all that stuff that obviously we as investors have access to. But private information is inside information. And since nobody knows that except for a very few people inside the company, that information is not in the stock price. It hasn't been incorporated yet. So when companies make announcements, essentially what they're doing is they're taking private information and making it public. So now we see it, we analyze it, and we decide what we're going to do value-wise based on that information. So again, public information. Again, if the impact is available to everybody, then we know the impact on future cash flows. Then we can assume that investors can understand how that will affect the firm's value. So we expect the stock price to react nearly instantaneously to any public information that's provided. There have been studies that have looked at time periods when information becomes available. 20, 30 years ago, when I was actually in my PhD studies, we didn't have things like the internet, right? I mean, those things really weren't popular back then yet. So that information craze hasn't happened yet. So what they did is they did studies on the Wall Street Journal's publications every morning. There were certain articles. They would look at those articles and they would say, well, they talked about this stock, this stock, this stock. Some of the information was good information about the stock, some bad. And they would look how quickly it took the stock prices to change from the moment that this information was made public. And it happened actually very, very quickly that there was a change. So again, we can expect prices to change very quickly. So here we have some examples, right? This company announces that due to some side effects, it's pulling one of its drugs. As a result, future cash flows are going to decline by 85 million a year because they're pulling this product from the market. They have 50 million shares, have equity cost to capital of 8%. If this news came as a complete surprise to investors, what would happen to this company's stock price? Well, again, if we use the discounted free cash flow method, we know that what? 85 million divided by 0.08, right? That's the cost of equity here. It has no debt. So the value is 570 million. So the share price would fall by 570 million divided by the 50 million shares. It's going to fall by $11.40. Because this news is public and its effect is clear, we would expect this stock price to drop nearly instantly, certainly within the end of day that this information was published. Now, what about private information, right? Or information that's just difficult to interpret, right? Again, we know it's inside information is the best way to talk about this. So in this case, the efficient market hypothesis doesn't hold. It assumes that the information is automatically in the price. However, if nobody knows it, how can it be in the price, right? So as informed traders begin to trade, we're going to see some prices move. But what about this private information? How does that get into the price? We know from, if you watch the news, you know that if there is insider trading and you are caught, I mean, that really kind of defies the definition of investment, right? Investment assumes that there is a chance that you could be wrong. If you have private information and you trade on it, you can't be wrong. The price has to move in the direction that the information drives you. So that's really not investing anymore. That's why insider trading is so illegal, is because there's no chance of loss. You have an advantage. So if proper profit opportunities from this private information are large, you know, people are going to really try to find it, right? They're going to take crazy steps sometimes to figure out what that private information is. So in the long run, we should expect that the degree of inefficiency in the market, that the fact that the prices aren't true prices, is limited by the costs of attaining private information, right? So the more expensive it is to get private information, the more inefficient the markets may turn out to be, because that information is so hard to get. So here we have, again, another example of looking at reactions to private information, right? So if approved, the profits of this new drug are 750 million or $15 per share for 50 million shares. If this development drug was a surprise to investors, and if the average likelihood of FDA approval is 10%, what would you expect to happen to the stock price? What's going to happen over time? Well, because many investors are likely to know chance of FDA approval is 10%. In fact, now you know that. So what would that do? 10% of the $15 increase in stock price, we would expect the stock price to go up by $1.50 per share on the announcement. Now, over time, however, experts, analysts, they're going to look at this drug. And if they conclude that this drug was more promising than average, they're going to start buying the stock and bid the stock up higher. If they conclude that it's less promising than average, then the opposite is going to happen, right? So while these experts, they can trade on their superior information, but what about us? What about the uninformed investors who don't know? Again, the stock price may rise or fall, and so it appears fairly priced at the announcement, but where is that going to go over time? And that's what this next little graph shows, that if on the day of the announcement, the stock price is going to go up $1.50, but what happens after that? As experts and as information comes to the public, if it's good information, if it's more promising, the price goes up. Less promising over the future, it goes down. That's the problem, I guess, with investing here, right? So the consequences are, if stocks are fairly priced, if you buy stocks, you can expect to receive future cash flows that fairly compensate you for risk. So the average investor can invest with confidence, even if they're not fully informed, right? So investing in stocks is not really a gamble, right? You are purchasing the future of this particular company. It's uncertain, but it's not a gamble per se. So what are the implications of this efficient market hypothesis for corporate managers? They need to focus on net present value and free cash flow. That is what they need to focus on. They need to avoid accounting illusions. The financial environment, analysts are very observant, right? I mean, that's their job, right? So if a company changes its accounting methodology and that changes earnings, financial analysts see that and they incorporate it, right? So they take that into account. So you cannot mislead the public by changing accounting methodologies. It just doesn't work. And in addition, we need to use financial transactions to support the investment. What this essentially means is, if you're focusing on net present value, that means you're going to gather funds to expend on the company. And you need to use those transactions. Don't think about pricing. Prices are true efficient prices, right? They are basically telling us what the value really is. So don't think about having too much debt, because if you have too much debt, the prices will change and the debt becomes much more expensive, and you wouldn't want to have more debt, for instance. So the efficient markets hypothesis eventually states that securities with equivalent risk should have the same expected return. So the arbitrage opportunity is when two securities with identical cash flows and risk have different prices. So when you purchase a stock and you have a gain, is that an arbitrage opportunity? Or are we just saying that you didn't have enough information to understand where the price was going to go? And we don't know what that answer is. So again, that's what we refer to as the efficient markets hypothesis. Look forward to seeing you in the next video.